Good evening, everyone. All of you, welcome to the final revision for BFM. All of you join fast. Revision for BFM. So audio video okay? Okay, everyone? Yeah. Chalo, let's start. I was just checking the audio video. Now everything is okay. So now let's start with the final revision, Maha revision we can call it, right? Let's start with the Maha revision or BFM. Okay? See, today is the last day of your studies, to be frank, isn't it? Tomorrow you will have the exams. So in Marathi we call it Vairyachi Ratra, means it's a dangerous night, right? Most exciting night, right? So all of you join fast. Hi, good evening, good evening, good evening. Creative thoughts, right? Chala. So everyone like the video, subscribe to the channel, click on the bell icon. Do this first. Do it right now. Again? Shall we start? Chalo. Let's start with major sixer. Okay? Today I'll be starting with, it's a revision. Okay? Revision. So today I'll be starting first. I'll give you the concept of LC and various banks involved in the LC. Very important, roughly around 7 to 8 marks minimum. You get it for this, huh? 7 to 8 marks. Various types of LCs, various types of banks. You get case studies on this. Okay? So let's start. Hi, good evening, everyone. Good evening. आवाज ठीक है? Yeah. One second. Okay. Chalo. So first one, look at this. Okay. Always look at it. LC. How the LC is processed. Before going ahead for LC, you must first know what are the various ways of doing business. What are the various ways of doing business? Okay. Number one is always advance payment. Always. See, this is not there in your portion, but this is the base of the LC business. First one is advance payment, in which the buyer will give the money first and then the seller will send the goods later. But this is risky. Why risky? If buyer gives the money first and seller will not send the goods, then what? Or if the seller sends lower quality goods, then what? So that's why it is risky for the buyer. Second type of payment is open account. See, sometimes you might get this open account concept because that is there still existing in our payment systems. Open account. Open account means what? In open account, the seller will send the documents also as well as the goods also. So documents and goods both will be handled by the seller only. Okay? And he will send the goods and documents to the seller, to the buyer, and buyer will pay later. Now this is risky for the seller. Why? Because if the buyer doesn't pay then, right? So that is the main problem. Got it? So third part is collections. Collections means here the documents are handled by the banks. Goods are handled by the seller and documents are handled by the banks, and money is also handled by the banks. See, money is everywhere handled by the banks only. Money part, everywhere it will be handled by the banks only. No volume? One second, just hold on. By the banks, and money is also handled by the banks. See, money is everywhere handled by the banks only. No, I am getting it properly. Everywhere it will be handled by the banks only. No volume? One second. I am getting the volume properly, everyone. I have just checked this. Just increase the sound if any problem. Low volume. Because it is same as yesterday. What was it yesterday? Same today also. One second. Let me see if anything is there. Audio, audio, audio. Hi, 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 hi. Yeah, let me check. Hold on. If I can increase it something. Hold on. No? Now check. Now it's okay. Now everyone check. Can increase it something. Hold on. No? Now just check. Hi, hi, hi. Let me see. Now check. Now it's okay. Yeah, now I think so. It's now everyone check. Yeah. Chalo. Let's move on then. Okay. So now, see this, everyone. See, collections means documents are handled by the banks. Money is everywhere handled by the banks only. There is no other organization which can handle the money part. Otherwise, that's called as Hawala then. Okay, Hawala transactions. So, whenever it's through banking channel, then it's proper. So, in collections, documents are handled by the banks. Okay. Now, I'll give you what simple logic of this. See, whenever there is a buyer and there is a seller, so they do a contract with each other, contract. Okay. So, buyer will give a purchase order, seller will give a pro forma invoice. Okay. And then what happens? LC comes in. Because collection also has a problem. In collections, what happens? The buyer might not pay. There is always a risk of buyer not paying. So that's why always all the three, this advance payment, open account and collections are riskier. That's why LC has come in. LC, letter of credit. As LC has come in, the risk of the payment is not with the buyer now. Under LC, the payment is made by the issuing bank. So the buyer will give the purchase order, seller will give the pro forma invoice or quotation, you can call it, quotation. And based on that, buyer will go to his bank. Buyer will go to his bank and his bank will provide an LC, letter of credit. Okay. So now his bank will give you the LC. Now this bank who issues the LC is called as issuing bank. See this name. Issuing bank name will be there. This bank which issues the LC is called as issuing bank. So now the question comes, if you are the issuing bank, what will you check? Whenever a buyer comes to you, see always for issuing the LC, buyer will come to you, seller will never come to you. Buyer will come to you because ultimately it's the buyer. Okay. So buyer will come to you and for the LC. So when the buyer comes to you, what will you check? You will first check pro forma invoice, purchase order, their contract if any, then other terms are IEC code. See, write down these terms or remember at least. These two things are there, contract is there, IEC code of that buyer. IEC code should be compulsorily there. Otherwise, you can't issue a foreign LC. Inland LC, you can do it. Local LC within Bharat, you can do it. But if you want to issue it for foreign country, IEC code is a must. Then next number is RBI's caution list. If this buyer is in the RBI caution list, you will always have to check this. Okay. And last one is even this OGL license. Means ECGC, Export Credit Guarantee Corporation. That gives two types of licenses. One is OGL. OGL means Open General License. What is Open General License? Open General License means simple. You can export or import the goods whichever are given in the OGL. Means what? See, I want to import, let's say, what, tables or chairs. Why permission is required? Table or chair is a simple term. So that will be in OGL. But imagine I want to import or export, let's say, hydrochloric acid, or I want to import or export some drugs, chemicals. So that will require permission because you don't know. For what are they used for? So that is known as special permission. So as a bank, when the customer comes to you, you'll always have to check whether the customer is having this OGL license or special license, plus RBI question list, plus IEC code, plus the contracts. So now here this bank has got all these documents, and now this bank will block the money of this buyer. Block the money. First it will take 110% of the FD. Suppose if this importer wants to buy $100 LC, he wants to prepare a LC of $100. So bank will take $110 FD first only. First we want our money. So FD will be taken and then the LC will be issued. Now this LC which is issued, it has to go to whom? Whom should it go? This LC has to go to this exporter, net. This LC has to go to this exporter. But how will it go? See, simple example I'll give you. This exporter is somewhere in, let's say, Bihar. Okay, Bihar or Tamil Nadu. Bihar, let's say any state. This seller is in USA. Now he goes to his bank, let's say Citibank in USA. How will Citibank know who is this person in Bihar? Whether this person is trustworthy, whether there is any fake thing happening, whether there is any AML thing happening. So that's why what does this issuing bank do? Citibank, let's say Citibank. I have worked in Citibank, that's why I'll call it Citibank. So this Citibank will do what? It will prepare its own agent in the country of this seller. So if he is in Bharat, so Citibank will contact a bank in Bharat, which is a popular bank. Any bank it can be. Okay? And it will send a SWIFT LC to this advising bank. This bank is now called as advising bank. Advising. Okay? See this. Advising. So this bank is called as advising bank. Got it? Now understand the role of advising bank. You'll get a question on advising bank. Always remember, advising bank is generally in the country of the exporter. Number one. And what is the role? What does it do? Advising bank. What is the role? Very simple. Advising bank's role is only two. Number one, check the authenticity of the LC. Authenticity means whether the LC has come from the right source or is it a fake LC. That is what is checked. So check the authenticity, and second is whatever has been received by them, whatever this Citibank has sent, whatever documents via SWIFT, take the printout of all of them and send it to the seller. See this. Advising bank forwards LC to the beneficiary and collects advising charges. So these charges are collected by the advising bank. Okay. So now what is happening? This bank has got an LC via SWIFT from the issuing bank. This LC is taken a printout now, and this printout is given to this seller. Okay? Is this live? Yes, live it is. Bhavani Puleppu. Any question you have? Any question anyone is having, kindly raise it right now, okay? All of you. Bhavani, it's live, huh? So, got it everyone? See, this is the role of, this is the flow of LC right now. So LC has now moved from this bank to this seller. Now what will happen? Once the LC is received by the seller, this seller is now confident. Yes, now I will get the payment from this issuing bank. See, always remember, in business what is important? Any business. What is important? Money. If you are confident of getting the money, then only will work. You work, see, many of you might have done some jobs in some earlier organizations. Suppose if the organization doesn't pay you, what happens? We all work in the bank. Suppose if tomorrow bank starts not paying you, okay, what will happen? For 1 month, 2 months, 3 months you will work. But after 3-4 months, you will say, "Arey, no payment, why should I work?" So same thing happens. So buyer, this seller over here will first check if the payment is sure. When he gets the surety of payment from this bank, then he will do the further part. What will he do now? So now remember, this is known as LC flow. So this is done now. Everyone okay with this? This is known as LC flow. Okay? Everyone okay with it? Now look at the second part. Second part is what? This manufacturer or the seller, now he has got the LC. Now he has got a payment confirmation. He knows that I will get the payment. So now what will he do? He'll start manufacturing the goods. See, he will manufacture the goods. This person, he or she, it's not he only. Okay? He or she. He will manufacture the goods and he will send it to this buyer. Now look at this. Pay attention. These goods will be sent to the buyer port. Buyer will not get access to the goods. Now the goods will shift from here to the port. Port, only port. And here once they reach the port, the buyer has to produce documents, BL, bill of lading. Now from where will he get the bill of lading? Now see this, pay attention. Now there are two ways. Goods go through the ship, okay, mainly ship only. And documents. Now what does this seller do? This seller will now prepare 6 documents. Which are the 6 documents? Pay attention. All of you, very important from exam point of view. Which are the 6 documents? This seller will prepare these 6 documents. Look at this. Bill of lading, bill of exchange and insurance. First 3. Read it everyone. Bill of lading, bill of exchange and insurance. Okay? First 3. Second is remaining 3 are invoice, packing list and COO, certificate of origin. Okay? I generally give it in what way? Those who know me or those who have attended my classes, you can tell me which are the 6 documents, how do we write to remember it very in simple way. Can anyone tell me? Correct. 2I, 2B, PC. Venkatesh. Correct? Venkatesu. 2I, 2B, PC. Kindly remember it in simple way. 2I, 2B, PC. 2I means invoice insurance. 2B means bill of lading, bill of exchange. And PC means packing list and certificate of origin. By heart this. By heart. Because you will definitely get a question on this. Now out of these 6 documents, kindly remember 3 are negotiable. Bill of lading, bill of exchange and insurance. These 3 are negotiable. Okay? Negotiable means what? Anyone who is having it will get the money. Anyone. These are called as negotiable document. Check. What is our check? Check is a negotiable instrument. Bearer. Right? Remaining 3, invoice, packing list and CO. These are not negotiable. Okay? See, whatever is prepared by the seller. See, invoice is prepared by the seller. Packing list is prepared by the seller. COO, sometimes it's prepared by the seller or it's prepared by the Chamber of Commerce. See, this question also comes. Certificate of origin is prepared by whom? Chamber of Commerce. So now these 6 documents, this seller will prepare. He will get it from all the companies. Insurance, he will get it from insurance company. BL, he will get it from that shipping company. Okay? And all these he will get the 6 documents. Now what next? This seller will now has sent the goods. Now the goods are over here on the port. Nobody can touch the goods. The goods are lying there only, port. If they lie for longer period, that's called as demurrage charges. Demurrage. 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 This question might come to you in exam. What is demurrage? Demurrage means goods are lying there and nobody is ready to take it. So the port authorities will charge you fine for this. That's called as demurrage. So now what will happen? This seller will prepare these 6 documents and give it to his bank now. Now which is his bank? Now remember, it is not advising bank. Advising bank is gone. Advising bank's job is only to give the LC. Now this is another bank. Now see this. It can happen that advising bank might say, I will prepare the, means I will work as an advising bank also. I will work as any other bank also. Because they can work, every bank wants money, every bank wants commission, right? So this bank can be advising bank also, but the name is different. Okay, it's like the same person who is also a husband, a son, a father, right? Person is same. I can act as a father also, I can act as a husband also, I can act as a son also, right? Same thing about females, okay? So same bank can act as a confirming bank also, can act as an advising bank also, can act as a negotiating bank also. Only the roles are different. So advising role, we checked it earlier. What is the role of advising? Just to forward the document. Courier. Okay, it's that simple. Now, what is this confirming and negotiating bank? See, whenever this seller, this is also called as beneficiary. See, there are three names to the seller. One is exporter, second is seller, third is beneficiary. Beneficiary means the one who receives the money in the end. Buyer has three names: buyer, importer, or applicant. Okay, these three names are there. So now what will happen? This seller will send the documents to his bank. Now his bank, now pay attention, very important term. Now his bank, if it says that, okay, who's going to pay you? See, ultimately who is going to pay you? Payment will be done by this issuing bank. But now what happens? This seller is from Bihar. Okay, Bihar, Tamil Nadu, any state. Now seller says, I don't trust this bank. I don't know this bank. I know SBI. I know PNB. I know any nationalized bank. So he will go to his nationalized bank, whichever account, wherever he has an account. He will ask his bank that, see, I don't trust this bank. You give me guarantee of payment. You give me guarantee of payment. Now see, if this is PNB, this is SBI, this is Bank of Baroda, this is Bank of Maharashtra, any bank. Now these bank will definitely know Citibank, although seller doesn't know, but bank will know it. So SBI will know Citibank. Citibank will say, okay, don't worry, Citibank is very good. Means SBI will say, don't worry, Citibank is very good. It will pay. So SBI will do what? Or any PNB, I am just taking an example of SBI. It can be any bank. So this bank will do what? This bank will say that, okay, I give you the guarantee that payment will be received on the due date. If it is not received, then I will pay on the due date. I will pay on the due date. So this is known as confirmation. Confirmation means additional guarantee of payment given by the Indian bank, local bank. Okay, confirmation means additional guarantee given by the Indian bank. Okay, got it? Kindly clarify me which document is given in duplicate. Okay, I'll clarify this. Which document is given in duplicate? Okay, I'll clarify this. Okay, so first understand this. I'll clarify that duplicate document later. Okay, so everyone clear up to here? So confirmation means this bank is giving you an additional guarantee that I will pay you. Local bank. See, now I am the seller. I am having two guarantees. One is from the issuing bank, second is from the local bank. So both the banks are guaranteeing me. But does it mean I will get double payment? No, I will not get double payment. This bank will pay me only if this bank is not paying. If the issuing bank pays, then this bank will say, what is my role? I won't pay you. That means I'll just transfer the money whichever is received. So guarantee is when the first party doesn't pay. Okay, clear? Confirming. Now what happens? This seller or exporter, he goes to his bank and says that, see, the due date is after, let's say, 60 days. This bank will pay after 60 days. So what I want is, I want the payment right now. So that is called as post-shipment finance. Post-shipment finance. So post-shipment finance means it's also called as negotiation. So this is called as negotiating bank. So this bank will say, let's say SBI. I'll take one common name now, SBI. Okay. Now this SBI will say that, okay, don't worry, I'll pay you right now. Loan I'll give you, loan, post-shipment loan. So this loan, when this bank gives it to the seller, it's called as negotiating bank. Understand the words. Confirming bank, only guarantee. Negotiating bank, payment. Okay, so these are the two banks. Next is what? If the name of this bank, let's say PNB or SBI, if the name of this bank is mentioned by the issuing bank in the LC, it says that if you want to negotiate, negotiate it from only this PNB. In that case, this bank is known as nominated bank. Nominated. Name of the confirming bank or the negotiating bank is mentioned in the LC. So that's called as nominated bank. So now what will happen? This seller has given these documents. Now all these three things have been done, either confirmation or negotiation. These have been done. Now this bank will do what? Let's say SBI again. So SBI will send the documents to the issuing bank. Because ultimately documents should go to whom? Documents should go to issuing bank. So SBI will send the documents to the issuing bank, right? Got it? For guarantee payment. Okay. I'll give you. Got it? So this will send the document. Now remember, where are the documents now? These 6 documents. This seller had prepared. He had given to his bank. Now his bank has given it to the issuing bank. So now where are the documents? Documents are over here with the Citibank, issuing bank. Okay. So now what has happened? This bank wanted the documents. This bank had issued the LC. The bank who issues the LC should get the documents. Very simple. The bank who issues the LC should get the documents. So they have got the documents. Now what is the role? Now this issuing bank has got the documents. Now it will check the documents, whether the documents are correct or not. If they are wrong, let's say the documents are discrepant, then the issuing bank will say, oh, forget it. I am not going to pay you. Documents are discrepant. It will send back the documents. That is simple. Documents are discrepant, I am sending back. Okay. But now, if the documents are correct, then this bank has to send money to this seller. Ultimately, this seller should get money. So how will it get money? Now comes the role of third bank. This role now. Now look at it. The documents are over here. They are correct. Documents are correct now. Now this bank has to pay to this seller. How will it pay? So it will pay through one bank, any bank in local country. Generally, it will pay through the same bank which has sent the documents. Now understand, two terms are coming to you now. New terms are coming to you. If this issuing bank, let's say Citibank, has an account with SBI. Pay attention. If Citibank has an account with SBI, or reverse also it can be, SBI is having an account with Citibank, anything, then that arrangement is called as nostro vostro. Nostro vostro. What is nostro? Nostro means my account with you. And what is vostro? Vostro means your account with me. Now imagine, understand this properly. Now, does it mean that there are two separate accounts? No, it is the one account only. It's only from whose angle I am looking at it. If SBI is maintaining account with Citibank, then SBI will say that I am having nostro account because my account with you. And Citibank will say it is a vostro account because your account with me. So account is same. Account is not changing. Okay. So this is called as nostro vostro. From whose angle you are looking at it. Okay. Now imagine one more case that these two banks don't have account with each other. They don't have. Citibank doesn't have account with SBI or SBI doesn't have account with Citibank. Imagine, this can't be practically, it's not possible now. But imagine it can be a case with some XYZ bank. So in that case, what will happen? They will search for a bank where they have the common account. With Citibank also has the account and SBI also has the account. So that arrangement is called as LORO arrangement. LORO. Nostro, vostro, LORO. You might have heard the names. So kindly note, LORO is not an account. LORO is an arrangement. Kindly note this. Nostro vostro is an account. Loro is not an account. It's an arrangement of accounts. Various. It can happen. See, I have seen when I was working with Citigroup, I was working with Citibank. When I was working with the Citigroup, the Loro arrangement was 6 to 7 banks. This bank with that, this bank with that, all these banks linkage and final payment used to receive. Means commission is there for each bank, but this can be the arrangement. So Loro means it's an arrangement between issuing bank and the this exporters bank, and this third bank, this Citibank will give the payment to this bank will give the payment to SBI. And SBI will do what? Ultimately, it has to give the payment to this seller. So, if SBI has given the loan earlier, post-shipment finance, if SBI has financed, then SBI will deduct its finance and whatever remaining, it will give back. So, here the transaction gets completed. Exporter got the payment, issuing bank got the documents. So, now issuing bank will give the documents to this seller, buyer. Right, by taking the money, whatever arrangement they have. Okay, so here the transaction ends. Okay, now your questions. All of you had asked, 2 questions were asked. Kindly clarify which document is given in duplicate. See, in duplicate there are 2-3 documents. Okay, see, mainly bill of lading. Bill of lading is always issued in triplicate, not duplicate. Triplicate is issued. 3 copies are issued of bill of lading. Okay, and you can get the material by just producing 1 BL. Out of these 3, even 1 you produce, then also you can get the material. Whatever goods are there on the port. So that is in triplicate. One more document is issued in duplicate, but that is not mentioned over here. That document is, look at this customs document. Okay. Customs document means whenever you send the goods from our country to foreign country, there is a custom house. This custom house will check whether the goods are correct or no. So when the custom house checks it, it issues a form. That form is called as EDF form, export declaration form. This form is issued in duplicate. Duplicate, huh? Okay. So this duplicate form means, now look at this. What is the duplicate form? This duplicate form is, one is customer's copy and second is ECC copy. Remember this name, ECC copy. ECC means exchange control copy. Whenever you are working in a bank, you must always get the ECC copy of the customs EDF. ECC only. You should never get the customer's copy. Because ECC is our copy, bank's copy. So which document is issued in duplicate? EDF form. Which document is issued in triplicate? Bill of lading. There can be bill of exchange also. See, there can be 1,000 possibilities. Bill of exchange, draft, this can also be issued in duplicate. But nowadays it is not issued, because nowadays we are in a internet age, so that's why we don't issue it that much in duplicate. But draft can be also issued in duplicate. Got it? Got the answer? Now next question was, what security confirmation bank takes for guarantee payment? Okay. So what security will this confirming bank take for guaranteeing the payment? Okay. Now there are 2 things. Okay. Firstly, understand, confirmation is always given on the lines or on the credit of the issuing bank. So this bank will generally not take any security because it is trusting the issuing bank. Number 1. But it can happen that some banks, because we are in Bharat, we don't give any loan other than without security. So it can happen that issuing bank, this confirming bank, will say that, see, I'll give you the confirmation subject to you have a proper loan system with me. Loan system means you are having CC term loan with me. See, RBI will say, what does RBI say? RBI says that whenever you are dealing with any LC bank guarantee, non-funded limits, you must always see to it that the customer with whom you are dealing should have CC and term loan with you. He should have the funded facilities. Only then You can issue the LC bank guarantee. You can't issue LC bank guarantee to anyone who comes tomorrow in the morning in your branch and says, give me the LC. You can't issue because there is a risk involved. You don't know what that LC is for, what that person is doing. That person might be a terrorist. So that's why you need to give LC or bank guarantee only to those guys who are having proper loan accounts with you, not current account, loan accounts with you. Got it? Everyone clear now? So next now, see, this was a LC system. You will definitely get around 8 to 10 marks on LC tomorrow. I am having one more case study, okay, that is related to transferable LC, but not right now. After some time, we will do it, okay. So now, next is now, see, this was module A, some part. Now, important part which will be asked to you in exam is the capital part. Always remember, you will get a question definitely on capital. Tier 1 capital, Tier 2 capital, CET 1s and 81. You will surely get a question. So that we will be covering today. Because it's a last day, I won't give you much pressure. What I will try to do is, I will try to cover whatever you have learned and which is directly useful for you tomorrow morning in the exam. Okay? So, see, today night we are having, means after this session, I will be having one Chalisa session also. Tomorrow morning I am having one more session, most expected paper. There also important questions are covered up. Don't miss that also. So, what is Tier 1 capital? Okay. Kindly understand, any bank, okay, any bank will have a capital structure in this way. This evaluation reserves, this, yeah. See this, any bank will have the capital structure in this way. Capital means money, okay. How should I collect the money? Capital will always be in the form of, capital means what? Money. I want money, okay. Any company which wants to run has to have the money, okay. So how will it get the money? Through two ways. Two ways, okay. One is known as Tier 1 capital, Tier 1. And second is known as Tier 2 capital, Tier 2. Okay, Tier 2. So this is also called as 82. See, A additional Tier 2, 82. Okay, additional Tier 2. Got it? Getting this, everyone? Yeah. This time schedule, it is at 11, Chalisa is at 11 PM today night. Okay, and this morning session is at around 5 AM in the morning. Okay, 5 AM in the morning. See, I'll give you right now only, I am having it. This is shift 1, shift 2, expected. See, this expected paper is at 6 AM. And Chalisa is at, Chalisa today is at 11, I think so, 11 PM, night. Okay, Chalisa is at 11 PM. Okay, so both of them are there. Don't miss them. Okay. So, see this, Tier 1 and Tier 2. Okay. What is Tier 1? Tier 1 is always known as, pay attention now to the words. It is known as free capital, free. Free means what? It's my own money. Okay, free means my own money. Tier 2 is what? Paid capital, paid. PAID, paid means what? This money, I am taking it as loan from somebody. I am getting a loan from somebody and then using it. So that is Tier 2 capital. Okay. Now, in Tier 1 capital, kindly understand, there are two parts. Tier 1 is also known as going concern. Going concern. This is also known as going concern. Going means what? In exam, you will get a question on going concern and gone concern. What is going concern? Going concern means which can absorb the losses without insolvency or bankruptcy. Means if a bank is having huge money, NII is huge. So you can have, if any loss comes, you can definitely absorb the loss. Okay. So that is known as going concern. And tier 2 is known as gone concern. Gone concern. What is gone concern? Gone concern means the payment will be done on when the bank is in liquidation. When you go for liquidation, at that time the payment will be done. So this is called as gone. Bank is gone. So gone concern. At that time the payment will be done. Okay. Now what are the parts in tier 1? In tier 1 you have, kindly remember, two parts. I'll write it over here. See this, CET1 and AT1. CET1 and AT1. These are the two parts of tier 1. Okay. Now CET1 and AT1, and what is it? Let's see that. So now let's focus on CET1. AT1 is there, CET1 here, tier 2. Revaluation reserve is a part of CET1. See this, I'll show you about CET1 over here. CET1 consists of 4 elements. Okay, CET1 consists of 4 elements. See, what is CET1 firstly? Tier 1 has two parts, CET1 and AT1. CET1 consists of 4 elements. What are the 4 elements? The 4 elements of CET1 are number 1, paid up capital. Paid up capital means shares, common equity shares we call it. Common equity shares or paid up capital. Okay, number 1. Number 2, you have net profit. Net profit, whatever is your profit, okay, that will be over here. Third is your reserves and surplus, R&S. Reserves and surplus. And fourth is your revaluation reserves. So this is over here, revaluation reserve. Reval reserves. Okay. So these are the 4 elements of CET1, common equity tier 1. Okay, these are the 4 elements of CET1, common equity tier 1. Kindly everyone read them properly. I'll be explaining you more on this. Okay. So now look at it. Revalue, paid up capital, you know, means basically it's a share capital. Net profit, you know. Reserves and surplus means what? What is reserve? Reserves and surplus come from your net profit. Whenever the net profit you receive, if you keep it for future, that is called as reserves and surplus. Or if you give it to the shareholders, it's called as dividend. So net profit can be distributed in 2 ways. One is dividend to the shareholders, or second is reserves and surplus. Okay. So these are the 2 things. Now what is revaluation reserves? Revaluation reserve means it will include the bank's property. Suppose if the bank is having a branch, that branch is purchased. So that will also be the property of bank. That can be revalued. Revaluation reserves are a part of tier 1 capital at 55% discount. Kindly note, revaluation reserves are always taken at 55% discount. Means it's taken at 45%. Okay. These reserves arise from revaluation of assets that are undervalued on the bank's books. Typically bank premises and marketable securities. Bank's premises means branch, or my bonds, the bonds which I am holding. Okay. So both of them can be the part of your revaluation reserves. Okay. The extent to which revaluation reserves can be relied upon as a question, blah blah blah, forget this. Don't read this. Okay. Only this much is important for you. Don't read remaining thing. Nobody is going to ask you all the details of revaluation reserve. So got it? So now remember, your CET1 has these 4 parts. CET1. Okay. Then you have AT1, additional tier 1. What is that? Additional tier 1. So Tier 1 is having two parts, CET1 and AT1. Now, AT1 will have only two elements. Which are those? One is PNCP, Perpetual Non-Cumulative Preference Shares, and second is IPDI, Innovative Perpetual Debt Instruments. Okay, IPDI. Now, what are these? These are basically bonds only, but these bonds are given for a longer period, 10 years, 20 years bonds. So, these are known as IPDI. Okay, so PNCP and IPDI. Got it, everyone? Now, what are the percentages that we'll study? But percentage I'll give you later. So, now we have studied Tier 1, CET1 and AT1. Now, we'll study Tier 2 capital. Tier 2 capital over here, this is a paid capital or this is a gone concern. Also known as supplementary capital. It is not a main capital. Main capital is always Tier 1. It consists of certain reserves and certain types of subordinate debt. Tier 2 items qualify as regulatory capital. Now, I'll give you very important parts of this Tier 2 capital. Number one is contingency reserves. Contingency reserves. Okay? Reserves. So, these reserves, okay, or they call it contingency reserves or loss reserves, general loss reserves. These reserves are always taken at 1.25% of RWA. 1.25% of RWA. This is contingency reserve. It is always taken at 1.25% of RWA. Second one, important one is, see, there can be others also, but important are two. One is this, and second one is subordinate debt. Subordinate debt. Okay. So, subordinate debt, it can never be greater than 50% of the Tier 1 capital. Subordinate debt can never be greater than 50% of the Tier 1 capital. Okay. So, maximum 50% it can be there. You will definitely get a question on this, 1.25% of RWA. Okay. One more question you get generally, that is, I think so, PNCP. Let me see. This PNCP. This PNCP question you get, what can be the maximum percentage of PNCP? It is maximum 15%, 15% of your Tier 1, of your T1. Okay. It can't be more than 15%. This also question you get it sometimes. But compulsory question is this. This 1.25% of RWA, you will definitely get a question on in exam. Yesterday also in the marathon, I took one question on this. So, you'll definitely get a question on this. Okay. Clear, everyone? Move on. Up till now, okay, so everyone? Okay. Okay, chalo. Next. So, now this is done. Revaluation reserves done. Now, one tough numerical. Very tough numerical. It is there in your module C. Very tough. It's really tough. That's why I've written it. See this. Numerical, very tough. This numerical, many of the, even teachers don't understand how to solve this. Okay. See, the risk weight assets of an Indian bank with a capital of 500 crores stand for 5,000 crores. So, risk weighted asset RWA is 5,000 CR. Now, capital is 500 CR. Okay. What additional amount of assets it can create with 20% risk weight? So tough this is, and CRAR is given 9%. See, in exam, if they give you CRAR as 9%, then take 9%. If they don't give you anything, imagine in exam they don't give you anything. That CRAR is what? 9 or 8 or... See, there are 3 CRARs. Do you know? There are 3 CRARs, 3 CRAR values. Okay. One is of Basel. Basel value is 8%. Okay. RBI value is, now there are 2 values of RBI. One is 9%, and if you add CCB, plus CCB if you add, capital conservation buffer, that is 2.5%, then it becomes 11.5%. 11.5%. Okay, so which one will you take? Will you take 9? See, we always follow RBI. We don't follow Basel. Okay, so which one will you take? So in 2021, RBI clarified to all the banks that you should compulsorily maintain 11.5% this CRAR. So it is compulsory for every bank to maintain this CRAR, not 9%. You have to add CCB to this compulsorily. Okay. So now the question. If it is given in the exam that, see, here it's given, take CRAR as 9%. So you'll take 9%. Okay. So now we'll move on with 9% only. So what is the question? This question means it's given in the Macmillan book, but they have not given the solution. They have only given the answer. The answer is 2,777. Only answer is given. Now in exam, luckily or unluckily, if they change the values, then what will you do? Then this answer is of no use. So how will you solve this? See, the question is, what additional amount of assets it can create? You want the additional amount of assets. So now CRAR standard is 9%. Okay. So see this. First one, remember, let the new assets to be created. Means we want additional assets. So let the additional assets to be created be X. Let the additional assets to be created equals to X. Okay. So if assets are X, what will happen? Immediately RWA comes in picture. What is RWA? Risk weighted asset. Okay, 20% is a risk. So if 20% is a risk, then what happens? Then additional RWA is 0.2x. See, if I am having additional 100 rupees assets, immediately 20 rupees is a risk. So that RWA I'll have to add. So 0.2x I'll have to add to this. What will I add to? To whom will I add? What is my earlier CRAR? Earlier CRAR is capital upon RWA. See, 9% is a standard CRAR. Standard given by RBI. But actually my CRAR is what? That is bank CRAR. CRAR formula is capital upon RWA. So that is equal to 500 upon 5000. See, these are the figures. 500 capital, 5000 RWA. So CRAR is 500 upon 5000 into 100 into 100 you have to multiply. So you get it as 10%. So your CRAR right now is 10%. What does RBI say? RBI says we keep it at 9%. RBI says keep it at 9%. You are 10%. So you are in good position. But now what happens is this 10% CRAR which I am having, I can reduce it to 9 also. Okay. Now what is the new CRAR? Now new CRAR will be, my capital is not changing. There is 500 only. So my capital is same 500 upon my RWA now. What is my new RWA? 5000 was earlier RWA and this is my new risk weighted asset 0.2x. So I'll add this 5000 plus 0.2x. So this is my new CRAR. But what does RBI say? RBI says, see, you maintain it only 9%. Don't maintain very high. If you maintain very high, that's your lookout. See, RBI says minimum I want 9%. After that you maintain 100%. We don't care. Okay. So now what will happen? 500 upon 5000 plus 0.2x. This is my new RWA. As per RBI, this should be equal to 9%. So 0.09. So now solve it. Once you got the equation, then it's very easy. 500 equals to 0.09 into 5000 plus 0.2x. So solve this. So 0.09 into 5000, that is 450, and this 0.09 into 0.2x, that is 0.018x, and this is equal to 500. So take 450 on the other side. So 50 equals to 0.018x. So what is x? 50 upon 0.018. So 2777.77. Got the answer? This answer is given in the Macmillan book, but they have not given the explanation. Never. I think so. Module C. Check this module C. You'll get this. Anyone has seen this numerical in Macmillan book? Has anyone seen this numerical in Macmillan book? All of you? Yes, anyone has seen this in Macmillan book? Chalo. Okay. Am I audible? Everyone, am I audible? Yes, in Macmillan book. Got it? Chalo. Next one. So now let's solve the next one. Okay. Banks are required to make Pillar 3 disclosures as per RBI guidelines. At least on a, this I think so yesterday we had done this. At least on a dash basis, irrespective of whether financial installments are audited. So, in module D, correct. So this we had done it earlier also, I think so. Just check it. It is on a Pillar 3 disclosure. Correct? It's on a quarterly basis. Very good. Pillar 3 disclosure is to be done on a quarterly basis. Okay? Pillar 3 disclosure is to be done on a quarterly basis. So it is quarterly basis. In the treatment of second loss facility, which of the below statement is true? Second loss, the deduction shall be made 40% from tier 1 and 60% from tier 2. The deduction shall be made 50% from tier 1 and 50% from tier 2. Then similarly 60 from tier, 40 from tier 2. What will be the answer in this? It is 50-50. Okay, 50-50. Okay, 50-50 is the answer. Correct. 50% from tier 1 and 50% from tier 2. Got it? 50 from tier 1, 50 from tier 2. Okay, 50 from tier 1, 50 from tier 2. Liquidity risk. What is liquidity risk? Risk related to purchasing power, risk related to firm's capital structure, risk related to inability to pay its dues on time, and risk related to fluctuation in profits. What is the liquidity risk? What do you mean by this liquidity risk? Yes? It is C, correct. Third one. Okay, third is the answer. C. Related to inability to pay the dues, okay, on time. Inability to pay the dues on time. Business risk. Risk related to purchasing power. Risk related to firm's capital structure. This is gone. Fluctuation in profit. See, business risk is actually, I'll give you the definition. Business risk is also known as strategic risk. Strategic risk. Okay. Strategic risk is always for the longer term, longer period. Okay. Strategic happens because of longer period. Means, for example, you can take it as this Nokia phones. Okay, Nokia phones were at one time they were in huge demand, but now there are Nokia phones gone. Same thing is happening for IT companies now. IT companies presently, because of AI, all the jobs of IT are vanishing, right? So this is all your strategic risk, long term. So here it will be related to the purchasing power. As the longer period goes, the purchasing power will reduce, okay? And this will give rise to the strategic risk of the business, okay? Financial risk. So this is gone and this is gone. Now financial risk will be only two. Risk related to firm's capital structure and risk related to the fluctuations in profits. Okay? Risk related to financial structure, firm's capital structure and fluctuations in profits. The answer is, okay, fourth, profits, correct. Financial risk means always related to profits. Your profits are not proper, okay. Which of the following statements is not true regarding basis point valuation of a bond, BPV? Which of them is not true regarding the BPV? Yeah. So the question is, business risk is second. This option is given, na, correctly? Yeah. So now, BPV, basis point valuation is not correct. Huh? Which of them is not true? So not true means basis point value of a bond is a measure of price volatility of a bond prices to 0.01% or 1 basis point change in the yield. A larger basis point implies bigger change in the price of the bond. Higher basis point value represents lower risk to the investor. So which of them is true? It is C. False. So not true means false. Okay. So which of them is false? False answer is this. Higher basis point valuation means higher risk. This means higher risk. Higher risk to the investor. Got it? Next, which of the following statements are correct regarding the value at risk? VAR. So which of them are correct regarding the VAR, value at risk? It is? It is 1, statement 1, correct? It predicts the worst case over a certain period of time under normal trading conditions. Very important part about VAR is normal trading conditions. Okay? This is not true. Why? Because VAR will not compare with various elements over here. Okay? With respect to all other assets and liabilities. VAR will compare with only the repo rates and the interest rate changes. So one only. Okay? Okay. Let's take a break of 5 minutes. Okay? Break. 5 minutes. Okay? Then we'll continue. Let's take a break of 5 minutes. Okay? Chalo, everyone again, let's start. Okay? Chalo, join fast. Again, everyone, let's start. Let's start again. Okay? Chalo, move on. So next, forex numerical. One of the important numericals again, arbitrage question. All of you join fast, join back. Very important numerical now. This numerical is an arbitrage numerical. Arbitrage. Okay, arbitrage numerical. Very important one. Chapter wise questions, chapter wise numericals. Okay. Possibility of numericals question. Who is this? Arun Kumar. See, chapter wise possibility of numericals. Arun Kumar has asked chapter wise possibility of numericals. Chapter wise. See, chapter wise it's very difficult. I'll give you in module A. Pay attention. In module A, you will get the numericals on chapter number 1. Module A, chapter number 1. Okay? Mod A. Chapter 1. Okay? How many numericals will you get? You will get case studies on this. Around, I'll tell you, 10 to 15 marks. Only on this chapter. 10 to 15 marks. Okay, marks. Very important numericals part. Because in module A, you don't have any other numerical. In module A, you do not have any other numerical. Okay, everything is theory next. Kindly study IFSC and GIFT City. I have given the PDFs to you in the paid classes. Okay, kindly study that IFSC and GIFT City theory. Very important one. Then in module B, you'll have major numericals on risk regulations in banking industry. Risk regulations in banking industry. Many numericals. Roughly, I'll tell you, again, risk regulations will be around 8 to 10 marks. Risk regulations in banking industry, 8 to 10 marks. Okay? 8 to 10 marks. This chapter is very much important. Risk regulations in banking industry. Then in module C and module D, there is no chapter wise numericals. You can get the numericals from anywhere in module C and D. Roughly again, in module C and D, you get total numericals combined around 10 to 15 marks total. So C and D, mod C and D, combined numericals which you get combined are around 15 marks. So roughly numericals, if you see, you get 10 plus 10 plus 15. So 10 plus 10, 20, 20 plus 25. This is generally 25 marks numericals, you will get it. Now there can be 1 or 2 case studies also. Case studies will be on numericals, you will get around 3 case studies on numericals only. Only on numericals you will get 3 case studies, compulsory. Okay? 1 will be from this and 2 will be from, 1 will be from this B and 1 will be from C and D. Only on numericals you will get 3 case studies. 1 mark many numericals you will be having. Got it? So focus on these 2 chapters, Mod A numericals and Mod B risk regulations. For theory part, I will suggest IFSC and GIFT City. Many questions will be there. IFSC and GIFT City and technology. Last 2 chapters of module A. I have given the PDF for reading. Only read that much. That much is enough. Do not read anything else. Whatever PDFs I have given, just read that much. You will get 60 plus compulsory. And the classes you have already followed. So 60 plus compulsory you will get it. Okay? So now let's solve this numerical. Okay? So what is this numerical? Let me remove all this. This is done now. Say this. What is this numerical? Say this. A trader observes the following exchange rates. This is the arbitrage numerical. trader observes the following rates. USD to euro rate is 0.09. It means what? 1 USD equals to 0.09 euro. Okay? 1 USD equals to 0.09 euro. Got it? Second one. Second one, euro to GBP is 0.85. Okay, euro to GBP is 0.85. Okay. So euro to GBP is 0.85. Next is GBP to USD is 1.32. So what does it mean? 1 euro equals to 0.85, 1 GBP equals to 1.32 USD. Now we have to find out the arbitrage opportunity. Arbitrage. Okay? Yes. See, how will you do it? See, those who know it. Okay? First, this problem will cover 2-3 things over here. First, it will cover the cross rates. So, cross rates means, say this. 1 USD equals to 0.9. So, suppose if I am having 1 million, it's given 1 million USD I am having. So, how many will I get the euros in this? See this. If I am having 1 million USDs, so out of this 1 million USD, I'll be getting multiplied by 0.9. I'll be getting 0.9 euro, means 9 lakh euros. Okay. So 9 lakh euros I'll be getting. 9 lakh euros just by multiplying it. 1 USD into 0.9. So 1 million USD into 0.9. 9 lakh euros. From this euro, what will I do? I'll purchase GBP. See this second one. Euro to GBP. So I'll purchase GBP. So 9 lakh euro into 0.85. 9 lakh euro into 0.85. So that will be equal to 7,65,000 pounds. Pay attention. Everyone try it yourself also. 7,65,000 pounds. That much pounds you will be getting. You will be buying. This is arbitrage. See, I am buying and selling at the same time. Right now, what have I done? I am having dollars. Immediately, I have purchased euros. Immediately, I have sold euros and purchased pounds. Okay. Immediately, what am I doing? I am selling pounds and again buying dollars. See this. Now, I am having 7,65,000 pounds. This 7,65,000 pounds, I will sell it immediately and buy dollars. So, in that case, what will I get? 7,65,000 into 1.32. So that is equal to what? 1,09,800. 1,09,800. So what am I doing? I am just crossing them. One cross, second cross, third cross. And what am I doing? I was having $1 million over here. In the end, I am having 1,908,800. So I have earned $9,800 just by doing nothing, just by exchanging. Okay, exchanging the money from here to there, I have got this amount. Okay, which is not the part of tier 1 capital. All of you got this numerical. This numerical, those who have, it is new for them. Okay, have you got it, everyone? It's just a cross currency. We are crossing it and earning. Arbitrage means what? Wherever I see the opportunity, this is the arbitrage opportunity. I am seeing the cross rates so fluctuating that I'll just by investing in 1 to second, second to third, third to again first, I'm earning just $9,800 immediately. Okay. So next, which of them is not the part of tier 1 capital? Equity shares issued, redeemable preference shares, share premium, general reserves and capital reserves. So which of them is not the part of your tier 1 capital? Okay. The answer is B. Correct. The answer is B. Okay. Which of them is not the part of tier 1 capital? The answer is B. Okay. B means redeemable. Redeemable preference shares. These are not the part of, these are the part of tier 2. Tier 2. Redeemable preference shares are the part of tier 2 capital. Okay. Tier 2. Next. The following is not an example of operational risk loss. So which of them is not the example of operational risk loss? Driver salary, penalties paid, loss due to fraud, compensation for loss of instruments in transit, payment due to award of ombudsman. So which of them is not an operational loss? Correct? Driver salary. Okay. Driver salary is not an example of operational risk loss. Okay. It is a regular payment. Remaining all are operational risk. See, penalties. Whenever RBI imposes any penalties, it's called as operational risk, operational loss. Loss due to fraud. That is also operational loss. Compensation for loss of instruments in transit. Also operational loss. Payment due to award of ombudsman, operational loss. So these are all operational losses. Okay? These are all operational losses. Which is not the part of operational risk? Inadequate internal process, inefficient people, failed system, defaulting borrower, and natural calamity. Which of them is not the part of operational risk now? D. No, 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 no. D is not the answer. D is a part of operational risk. Kindly note. D is a part of operational risk. Default, sorry, D is right. Sorry. I thought last one is D. There are 5 options over here. I thought last one was D. Okay, so that is right. Again, defaulting borrower is not a part of your operational risk. I was thinking this is D. So natural calamity, it's a part of your operational risk. See, all these are operational risk. Internal, inadequate internal process, inefficient people, failed system and natural calamities. These are all operational risks. Okay? What is meant by banking book? Now, there are 2 books in banking. Okay? One is banking, second is trading book. Trading. There is third one also. Okay, one more book is there. That's called as merchant book. Merchant. There are basically 3 books. Banking book, trading book and merchant book. Okay. Banking book means what? It includes all the regular compliance issues, day-to-day banking issues. CRR, SLR, bonds which are purchased in banking book are HTM, held to maturity. They are HTM, held to maturity. Okay. Bonds which are purchased, these are held to maturity in banking book. They are never sold. Okay. Bonds which are purchased in trading are HFT, held for trading. HFT, these are known as HFT bonds, held for trading. Okay. These are HFT. And merchant means what? Merchant book is a book which is for the clients. Let's say Reliance. Reliance will say, I want $1 lakh. I want TCS tomorrow will say, Infosys will say, I want to sell $1 lakh. So that is known as merchant book. Okay. Which you do for the clients. That is known as merchant book. Okay. So, what is meant by banking book then? It consists of off-balance sheet items. It consists of on-balance sheet items. It consists of both off and on-balance sheet items. It consists of items appearing in the bank's ledger and other books. It consists of all investments portfolio of the bank. Now see, it can be, suppose if you get the options, okay, mainly the option over here will be, this option over here will be, it consists of this investment portfolio. See, this is mainly for treasury. So it is for the investment portfolio of the bank from the banking angle. Okay. But if remember, if they give you the option of all of the above, okay, then the option can be all of the above also, because this off balance sheet, on balance sheet, these are all the banking book items. Okay, so you, whatever is in your banking will always be there in the banking book. Mainly this is related to treasury. Okay, if you don't get all of the above option, then the option will be, it consists of all investment portfolio of the bank. Investment portfolio, this is related to HTM. Okay, but remember, if somewhere you get the option of all of the above, because many of these elements of and on balance sheet items, these are also included. Okay, it consists of banking ledger and other books. It can be also part of your banking book. Now all of the above is not there, that's why E is the option. Okay, otherwise if all of the above is there, then it will be all of the above. Interest rate risk is a measure of. Interest rate risk is a measure of. Yes. Interest rate risk is a measure of. So interest rate risk is a measure of, what is the answer? Market risk. Correct. Interest rate risk is a measure of market risk. Always remember, market risk will have many elements. Market risk will have many elements. It can be interest rate risk, it can be liquidity, it can relate to your this time risk, okay, funding risk. Market risk can be for any type. Okay. Always remember, credit risk, okay, is of two types. Kindly remember this. Credit risk is of two types. Okay. Number one, counterparty risk, and second is country risk. Okay, country risk, counterparty and country risk. Okay. Market risk can be of many types. How to measure the risk? For measuring market, credit and operations risk, all the three risks when you measure, for measuring the three risks, there are three methods. Everywhere there are three methods. For credit risk measurement, you have three methods. Okay, standardized approach, standardized approach. Second is this foundation. Okay, foundation and advanced. Foundation and advanced. Okay, advanced. For standardized method, foundation method and advanced method. This is for credit risk. For market risk, you have separate two methods. Duration approach, duration is there, BPV is there. Okay, this is based on sensitivity. And there is one more method that is based on VAR, value at risk. So net there are three methods. For operational risk, again there are three methods. Basic indicator approach, standardized approach, and last one is your this AMA, advanced measurement approach. So three methods for all. Okay. So now market risk is this. Next one. What is the maximum capital conservation buffer prescribed under Basel III? What is the maximum CCB prescribed under this? What is the maximum capital conservation buffer? All of you, yes? The answer is 2.5%. Okay, kindly note, see, both the buffers, remember, double CB, CCB, that is also 2.5%, and there is one more, triple CB. Triple CB means counter-cyclical capital conservation buffer. Counter-cyclical, that is also 0 to 2.5. 0 to 2.5%. See this. CCB is compulsory for everyone. Compulsory. Every bank it is compulsory. Triple CB, now understand this triple CB. Pay attention to triple CB. Okay? Triple CB, up till now, RBI has never put it. RBI never puts. Never put it. Okay? RBI has never put this triple CB up till now. RBI has never put triple CB up till now. Okay? But if RBI wants to put this, only I am talking of triple CB, not capital conservation buffer. Triple CB. If RBI has to put triple CB, it has to give 4 quarters notice. 4-quarter notice. Okay, it has to give 4 quarters notice to the banks. Compulsory. 4 quarters notice is compulsory. If it has to give the, if you apply the triple CB. Okay. This numerical with different currency was there in May 24. In May 24, they had asked the same numerical with different currency. The name of that currency was Saudi Riyal. At that time, they had asked for Saudi Riyal. Saudi Riyal. Okay. So they had asked for this question, Saudi Riyal. Name is only changed, remaining is okay. Okay. So what is the case? Look at this. Calculate 1 year theoretical forward rate for BRL. BRL means Brazilian currency. It's a Brazilian currency. BRL lira, I think so. Brazilian lira to USD. Given the following: spot is 3.9 BRL to USD. Interest rate in Brazil is 17%. Interest rate in USA is 1%. So now you have to calculate the forward rate. See, theoretical forward rate. You want the forward rate of this. So how will you get the forward rate? Anyone can try this? How will you get the forward rate over here? For getting the forward rate, the formula is, kindly note, 1 plus H upon 1 plus F is equal to F upon S. Now the formula I will tell you. This part is for interest rate. Interest. Okay. This interest, these two over here. And this part is for forward and spot. Forward and spot. Okay. So this part is for interest rate and this part is for forward and spot. Okay. So now H means home currency. Home. And F means foreign currency. Always remember, dollar is always the foreign currency. Dollar equals to always foreign currency. Always. foreign currency. Dollar is always foreign currency. Okay. So what will you do now? Yeah, domestic currency BRL. Always remember, any problem which you get, dollar will always be the foreign currency. Okay. So in this case, 1 plus H is what? Home currency, 17%, 0.17 upon 1 plus F, foreign currency, 1 plus 0.01. That is equal to F. See, this is required, forward rate. F upon, what is spot? Spot is given, 3.9. 3.9. So now it's just a matter of calculation. So solve this, everyone. 1 plus 1.17 upon 1.01. I think so somebody has got it. 4.52. 4 point something you will get it. Is it 5 point? Karthik? Is it 5 point or 4 point? Just check this, Karthik. 4 point, na? Yeah. So this F you get it as foreign currency, forward rate you get it as 4.52. See, the same question was asked in May 24. Okay, same question was asked in May 24. But at that time, they had given a 5 marks case study. This problem was a 5 marks case study. In that, what did they do? They asked 2-3 questions together. One was Saudi Riyal, second was USD, and third one was rupees. So 3 currencies were given, but formula was same. Once they asked find a forward rate for Saudi Riyal, then they asked find a forward rate for USD, then they asked for separate months, 3 months separate, 6 months separate. Everywhere all the 5 marks were based on single formula. 1 plus H upon 1 plus F equals to F upon S. Same formula you should rectify, learn by heart. Okay. This problem, if it comes, because it will definitely come with some other name. It will come with the name of Saudi Riyal. Now this time they might not give you Riyal. This time they might give you some other currency. Whatever it is. Formula is important. Okay. Everyone clear with this formula? Very important one, this part. Okay. Clear? Chalo, move on. So, next. This is done. From the above numerical, see, same numerical above is continued. Huh? Suppose 1 year forward is 4.10, but the theoretical this is 4.52. If I borrow USD at 1%, what is your arbitrage profits? Forget it, it won't be there. Huh? This is very tough for you. See, I have solved it, but it's not for your CAIIB. At CAIIB level, this is not asked. This will be asked in risk management elective. This numerical will be asked in risk management elective. Only first part will be asked to you. This part will be asked to you. This second part is for those who have taken risk management as an elective. That will solve it later. Okay, this is such big. This one is the answer. Okay. The primary responsibility of understanding the risks run by the bank and ensuring that risks are appropriately managed should be clearly vested with the, so risk should be appropriately managed. So it is vested with whom? CEO or board of directors or auditors or shareholders. So who will first check whether the risk is properly managed or not? Who will first check whether the risk is properly managed? It is always board of directors. Okay? Always remember, board of directors will first check whether the risk is properly managed or not managed. Okay? So the answer is BOD. Board of directors, they will always check this. BOD first, board of directors, below them is RMCB, risk management committee to board. Below there are three committees. Okay, CRMC, Credit Risk Management Committee, ORMC, Operations Risk Management Committee, and ALCO. ALCO. So this is the overall structure. Below this, there are groups called as support groups. Support groups. Okay, there are groups called as support groups. Okay, so this is the overall structure of the banking risk management framework. Your first chapter in module B, it is this. Board of Directors, then Risk Management Committee to board. Below there are three committees, CRMC, ORMC and ALCO. And below that, there is a support group. The support groups are for all. So, the answer over here is what? Board of Directors. Okay. RAROC is modified return on investment figure that takes elements of risk into account. Which of the following is a formula for calculating RAROC? Expected return upon economic capital, expected return upon value at risk, expected return upon total assets, returns minus cost of hedging upon capital. Yesterday, in marathon, we took one numerical, right? We took one numerical. Okay, I'll give you, Srikant, I'll give you the answer. What is Chief Risk Officer? Okay. Yesterday, we took one numerical. All of you have followed this yesterday's marathon, right? Because it was taken completely, full numerical was taken. And it was really tough one, RAROC numerical. Correct? So the answer is returns minus cost of hedging upon capital. This capital is called as economic capital. Cost of hedging, and there is one more which can be added, that is your return on capital, ROC. Okay? So the answer is this D. D. Yeah, somebody had asked one question. What was the question? Chief Risk Officer, where he is from? Chief Risk Officer. I think so it is related to this question. Yeah. It is related to this question. What is the role of Chief Risk Officer? See, kindly note, I'll give you 2-3 points now. Okay? Chief Risk Officer is an independent person. He doesn't have this sales target. Okay? Chief Risk Officer doesn't have a sales target. Chief Risk Officer will always report to two parties. Number one, MD. Second one, Board of Directors. Second one is Board of Directors. So, Chief Risk Officer will report to two parties. One is MD and second is Board of Directors. Okay? Got it? There is one more element which will come to you. CISO. 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 CISO will always report to whom? Will he report to Chief Information Security Officer? This question will also come now. Because this is a major focus of RBI now. RBI is focusing everywhere on CISO only. So, CISO will report to whom? CISO will report to, not to the IT head. He will report to the risk head, means Chief Risk Officer. So, Chief Risk Officer will have the reporting of CISO. Okay, kindly note this. Okay? Got it? Chalo, move on. This I know because I was giving a lecture on with some RBI training at that time, few days back. At that time, this question had come. For an assessment of working capital needs of a borrower who requires fund-based limits in excess of dash crores, the cash budget system should be used. So, in excess of what amount will you use the cash budget system? Cash budget. So, in excess of what amount will you use the cash budget system? It is cash budget is above. What is the answer? Let me see. C, 10 crores. 10 crores is the right answer. 10 crores. Okay. The answer is 10 crores. Okay. Everyone like the video. Like the video. Subscribe to the channel. Click on the bell icon. The answer is 10 crores. Okay. Cash budget system 10 crores. This is done. The ceiling for banks in providing advances, loans to borrowers is dash percent of the capital funds in case of single borrower and dash percent in case of group borrowers. What is the answer over here? Yeah. Now your book is giving 10 crores. Let me see if any change is done now. If any change, no, 10 crores only. Yeah. There is 10 crores only. Karthik, that ChatGPT is not giving the correct answer over here. The correct answer is 10 crores only. I have just now checked it. Okay. Now also it is 10 crores. Okay. So what is the answer for this? The answer for this is, for single borrower it is 15% and group borrower 40%. So 15 for single and group is 40. Got it? 15 for single, group is 40. Okay. Now this can be extended by 5% extra. So you can give 15 plus 5 and 40 plus 5. So you can give 5% extra. But when? This is only possible if this 5% is used in infrastructure. Infrastructure. It is given in infrastructure, only in that. What is infrastructure? How will you know whether it's in infra or not? So this list, infrastructure, is given as harmonized list. Harmonized. You will definitely get a question tomorrow on harmonized list. This question is there in your module C, module D also. Harmonized list. Harmonized list is always given by the government. This list will have all the projects which are included in infrastructure. Okay. So it is given by harmonized list. Got it? So 15 plus 40 and extra 5% you can take. Okay, if it is in infrastructure. Got it? Case study now. Now this is related to LCs, letter of credit. Some of you might be knowing this who had attended the earlier lectures. Some of you had attended. It is a revision for you. Okay, all of you, it's a revision. After all, our session is revision only. Okay. So this is very important case study. It will give you many important highlights and points, okay, about this. So, Mumbai-based Indo-Dutch spices, an exporter secures a substantial export order from the client in Netherlands. So this is the Mumbai-based client. This is Netherlands. Okay, so issuing bank is in Netherlands. And here our client is Mumbai based, but this person is an agent. Okay, this person is an agent. So to execute this, they need to purchase raw materials from Kerala. So now understand the transaction. Netherlands is giving the order to Mumbai. Mumbai is purchasing the goods from Kerala. So basically Mumbai person is an agent, middleman. Okay. So now whenever you have this transaction, you take either back-to-back LC or you take either transfer LC, either of these two. Back-to-back or transfer LC. Okay. Now what is back-to-back LC and what is transfer LC? Whenever, see, this Netherlands guy, this person will give one LC. This is LC number 1. See, LC number 1. Okay. This Netherlands person will give a LC number 1 to this Mumbai person. Now pay attention. Huh? Now pay attention further. If this Mumbai person transfers the same LC, see this same LC, LC number 1 only. 1 is given to Kerala. Same LC is transferred to Kerala. That is known as transfer LC. Okay, that is known as transfer LC. Amount is changed. Amount is changed, dates are changed, but same LC is transferred. Now, if this Mumbai person changes the LC, means he prepares a separate LC now, separate, altogether separate. Then that's called as back-to-back LC. So remember the logic of transfer LC and back-to-back LC. Transfer LC means same LC is transferred. Back-to-back means new LC is prepared. Okay. So this is the basic logic of transfer and back-to-back. Got it? So now look at this. Kerala immediately, but they lack sufficient working capital. So this Mumbai person is not having money. So he is lacking working capital. Indo-Dutch Spices means this Mumbai. Okay, Mumbai receives the irrevocable export LC from Netherlands. So he has received this LC number 1 from Netherlands. What is irrevocable? Irrevocable means it cannot be cancelled without the consent of all the parties. Okay, consent of all the parties. That's called as irrevocable. So what does this Mumbai guy, Indo-Dutch Spices, do? He approaches the ABC Bank in Mumbai to finance their purchase. So this person goes to a bank and says that, see, I've got this LC number 1. Now you finance me. Finance me means what? You either give me the transfer LC or you either give me the back-to-back LC. So this ABC Bank does what? See, for this purchase, ABC Bank, acting on the basis of received master LC, opens a new separate LC. See, this new LC is prepared. Whenever you prepare a new LC, then that is called as what? Transfer or back-to-back? Now you tell me. Just now I have clarified this point. If new LC is prepared, it is called as back-to-back or transfer. Yes? What is it called as? Back-to-back or transfer. New LC is prepared. See, this bank has prepared a new LC over here. So what is that called as? Correct. Back-to-back. Very good. Who's this? Venkatesu. Okay. So back-to-back. Karthik, back-to-back. Very good. So that is called as back-to-back LC. Got it? So this is back-to-back LC. So now this bank has prepared a back-to-back LC over here. Okay. This type of financing is known as back-to-back LC. Now this you have understood it. This will move ahead now. Okay. Now you have understood the case. Netherlands guy has given a LC to Mumbai. Mumbai has prepared a new LC to Kerala. Now answer the questions. Based on the scenario, what type of LC ensures that Kerala supplier gets paid and the Indian exporter receives funds while ABC Bank manages risk using the original LC as a collateral? So which is the case where original LC is kept as a collateral? Revocable LC, back-to-back LC, site LC and clean credit, clean LC. Yes, it is back to back. Got it? It's correct. Back to back. Okay, back to back LC. So the answer is back to back. But my question is, back to back understood. What is this clean LC? Clean LC means what? Site LC, I'll give you the answer. Site LC, we are having one question also. What is this clean LC? See, in this clean LC, what happens? I told you earlier that in any LC, there are 6 documents. 6 documents, right? 2I means invoice, insurance, bill of lading, bill of exchange, packing list, and certificate of origin. These are the 6 documents. Invoice, insurance, bill of lading, bill of exchange, packing list, and certificate of origin. These are the 6 documents. This is known as documentary LC. This is known as doc LC or documentary LC. Whenever you have clean LC, you have only one document, that is bill of exchange, BOE. Only one document you have, that is bill of exchange. Other documents are not there. One is there, bill of lading is not there, packing list is not there, certificate of origin is not there. Only one document. That is known as clean LC. This is very risky. Clean LC will always have a risk weight of 100%. Risk weight of 100% will be there on clean LC. Remember the 3 CCF factors: 100%, 50%, and 20%. We took one numerical also in one of the YT series. 100%, 50%, and 20%. Whenever you have a standby LC as a financial guarantee, pay attention everyone. Whenever you have a standby LC as a financial guarantee, standby as a financial guarantee, kindly remember, standby as a financial guarantee, the risk is 100%. Whenever you have a standby for general purpose, again the risk is 100%. But remember, whenever you have a standby for particular transaction, pay attention this. Whenever you have a standby for particular transaction, then the risk is 50%. See, standby for particular transaction, particular. Do remember this transaction. Risk is 50%. Okay? Documentary LC, risk is 20%. Documentary LC. Okay? So kindly remember this. Standby question comes in exam. Financial guarantee, general guarantee, 100% risk. Particular transaction, 50% risk. Okay? And documentary LC is 20% risk. You have to remember this. Tomorrow you will definitely get this question. 100, 50 and this 20%. Performance bond or performance guarantee, 50%. Okay? Clean LC, 100% risk. This is known as CCF factor. Okay? Chalo, move on. So now this is back-to-back LC, done? Yeah. If the Netherlands buyer wanted the ability to amend the LC without prior notice to Indo-Dutch spices, means Mumbai guys, which type of LC would they have issued, although rarely used in international trade? So if this Netherlands buyer wants to change the LC anytime on his own, so which type of LC does he want to issue? Which type of LC should he issue? He wants to change the buyer anytime. Change the LC. So it is called as revocable LC. See, one question will be there on back-to-back, transferable, revocable, site, usance. You will get a question on this. Okay? So, the answer is revocable LC. Revocable, correct? Revocable LC means that LC which can be cancelled anytime without the consent of any party. Only issuing bank can cancel it anytime. Okay? If the Dutch client fears ABC Bank might default and asks a bank in London to guarantee the payment on master LC, what type of LC is created? So now look at it. Additional guarantee is given by a third bank. Okay, additional guarantee is given by a third bank. So what is this LC called as then? Back to back, confirmed, revocable and cite. What is this LC called as? It is confirmed, correct? Confirmed LC it is called as. So it is called as confirmed LC. Kindly note. It is called as confirmed LC. So the answer is confirmed LC. Confirmed LC, just now we discussed it in the initial part of the lecture, right? Where other bank gives a guarantee of payment other than the issuing bank. Okay? Under which LC type can the Indian exporter immediately present the bill of exchange to ABC Bank and take funds right away, assuming the Dutch buyer pays immediately upon presentation? So in which LC will our party, Indian exporter, means Mumbai person, that Indo-Dutch spices, in which LC can this Mumbai person or company get immediate payment, acceptance, usance, cite and revocable? So in which of them will he get immediate payment? Immediate payment will be cite, correct? Cite LC. Cite LC will be immediate payment. So cite. Okay. Now few other points let me cover. Although the answer is correct, cite. What is usance LC? See, from payment perspective, there are three types of LCs. From payment angle, there are three types of LCs. One is cite, second is usance, and third one is deferred. DEFERRED, deferred. Okay, these are the three types of LCs. Okay, or you can call it bill of exchange also. So cite means what? Immediate payment. Immediate payment. Immediate payment. Okay, cite means immediate payment. Usance means what? Usance. It is in future date. Future date. Okay, but the problem is in future date, whenever you have a future date, here you have bill of exchange, BOE. BOE is there. In deferred, this is again future, but no BOE, no bill of exchange. No BOE is there. Okay? This is the difference between cite, usance and deferred. This is the difference between cite, usance and deferred. Got it? Got it? Clear? So, green clause LC. What is green clause? Chalo, let me explain you that also. Okay? I'll explain you. What is green clause, red clause? There are two types of clauses. One is red clause, red. And second is green clause, green. Okay? What is red clause and green clause LC? Because in exam you will get a question on red clause. Generally they ask you red clause. Green clause they rarely ask you, but you don't know. So red clause means what? Pre-shipment finance. Pre-shipment. Whenever any LC allows you to get pre-shipment finance, whenever any LC allows you to get pre-shipment finance, it's called as red clause LC. Then what is green clause? Green clause means it allows you to get pre-shipment plus it allows you to get warehouse finance. So it allows you to get pre-shipment and warehouse finance. So two finances are available in green clause. Pre-shipment finance and warehouse finance in green clause. Red clause, only one finance is allowed. Pre-shipment. Got it? That is the meaning. Anyone more? Warehouse purpose green. Correct. Srikant. Warehouse. Okay. Green clause means warehouse will also. But remember, green clause means pre-shipment also and warehouse also. Both of them are there. It's not only warehouse. It is both. And red clause is only single. Got it? Clear? Next. Done? Yeah. Now, next one. Okay, we'll take a break of 5 minutes. Break of, let's say 10 minutes we'll take. 10 minutes. Okay? And then we'll be back. Okay? I'll have something to eat. Okay? Chalo, let's start again. Hello, hi. Let's start again. So which of the components of the bank's balance sheet is not included in the liabilities? So which of them is not included? Okay. So let's remove this break now. So not included. So which of the components of the bank's So the answer is bank's liabilities. Liability means basically you are talking of see liability. So OD is an asset. Remaining all are liabilities. Inter-office adjustment, provisions for income tax, capital. All are adjustments. All are liabilities. Which among the following is not an element of Tier 1 capital? Revaluation reserves, paid up capital, statutory reserves, other disclosed free reserves, PNCPs, innovative IPDI. All of the above are a part of Tier 1. So what is the answer? Which one is not the part of Tier 1? What do you think? Which one is not the part of Tier 1? Yes, which one is not the part of Tier 1? It is all of the above. Okay, are the part of Tier 1. Correct? Just now we saw this. So all of the above. Which are the reinforcing pillars of Basel II framework? Even Basel III you can call it, same thing. 2 and 3 are same. So which are the reinforcing pillars? Minimum capital requirement, supervisory review and market discipline. Only A and B, B and C, only C, A, B and C. So which are the reinforcing pillars of Basel 2 and 3? It is all A, B and C, all of them. Okay? Kindly note, all of them. Okay? See this. Basel 2 and 3, minimum capital, SREP, market discipline. Okay? It goes from this side. Minimum capital, this is to be maintained by the bank. SREP is to be performed by the auditor. And market discipline is for the investor. Complete disclosure part. Okay? Under REROC framework, lender begins by charging to cover the expected loss, expected default rate, and the rate of this rate of rating category of the borrower. So, what will we apply on the expected loss? So, profit markup, interest markup, rate of return or risk premium. So, under REROC, what will you apply? Will you apply profit markup or interest markup or rate of return or risk premium? So, it will be risk premium. Okay? REROC means always risk premium. Got it? Which of the following are eligible for financial collateral? Now, this one was a question. Few days back also I had asked you. Okay, I have checked it in the books also. So now they have given, I have seen it, that earlier I told you all of them. But when I checked your book, see, we have to go as per your books. Practically all of them are allowed. But your Macmillan book says that this is not allowed. Mutual funds and equities are not allowed. Okay, as a financial collateral. Practically we give LAS loans also. What is LAS loan? Loan against securities. That is basically against MF and equity only. So we give it. But as per the Macmillan book, which is the main for all your exams, it says that only debt securities rated by chosen credit rating agencies attracting 100% or lesser risk weight, rated as BBB minus when issued by the public sector bank. So this can be added. And Kisan Vikas, life insurance, gold, all these can be added as a financial collateral. So it is 2 and 3. Okay? Only. But your Macmillan says that it is 2 and 3. We have to follow the Macmillan. You have to get the marks net, right? Even I know all the 3 are correct, but we require marks. So follow whatever is given in the Macmillan. Okay? So mark the answer as 2 and 3. Which of the following is correct definition of Macaulay duration? It is defined as the weighted average time for cash flows of a bond where the weights are nothing but present value of the cash flow themselves. It is a net sum of cash inflows and outflows. It is a ratio between the fixed income portfolios price sensitivity to interest rate changes. It calculates the investment rate of return and annual growth. So see, this big definition is Macaulay, correct? Whatever is a big definition is always generally right, right? So the answer is A. Got it? The answer is A. It is defined as the risk-weighted average to cash flows of a bond where the weights are nothing but the present value of the cash flows themselves, present value. Okay, what is Macaulay duration in simple language? Macaulay duration in simple language means the duration within the life of the bond in which the interest rate risk is zeroized. Kindly note this. Interest rate risk. Interest rate risk, okay, equals to 0. This is the meaning of Macaulay duration. The interest rate risk of the bond becomes 0, okay, in Macaulay duration. For one more question I will give you. For zero coupon bond, tomorrow you will get one question on this. Zero coupon bond, okay, bond. Macaulay duration equals to, remember this, Macaulay duration for zero coupon bond is equal to life of the bond, tenure of the bond, okay. So this question will be there tomorrow. Macaulay duration for zero coupon bond is equal to the tenure of the bond. Whatever is the tenure, remaining tenure, that is equal to Macaulay duration. Only in zero coupon bond, okay. Yesterday in marathon, I took one numerical on zero coupon bond. Okay, kindly follow that also. Okay, don't miss that. So the answer is this. Then see this. I have given here a bit clarification. Durations are of two types, Macaulay and modified. Okay, this is a part of sensitivity analysis. Macaulay duration means interest rate risk equals to 0. What is modified duration? Modified duration means percentage change, note this, percentage change in the price of the bond for 1% change in the repo rate. Repo rate means interest rate. Okay. So modified duration means what is the percentage change in the price of the bond for 1% change in the repo rate. Okay. Or repo rate means you can call it interest rate also. Everyone like the video, subscribe, click on subscription button. Like the video everyone, click on subscription button. Okay. So next, got it? So the answer is, you got it, Macaulay? Yeah. UCP 600 defines original documents with more precision. According to UCP 600, which of the following is considered as original document? So which of them is original document as per UCP 600? So it is any document being apparently original signature, mark, stamp, any document that appears to be written, typed, perforated by the issuer, any document that appears to be on the document issuer's original stationery. So it is D, Correct? D. It is D. Okay? Next. Uniform customs under UCP 600. Time allowed for the two banks for document review is, means what time is allowed for the banks to review the documents. 5 banking days, 7 banking days, 10 banking days and 14 banking days. What is the time allowed by the bank for the banks to review the documents? It is A. Okay, 5 banking days. I'll give you 2 days very important which are asked in the exam. One is 5 banking days. Advise the valuation of rates on the ongoing market rates. According to these guidelines, the banks have to undertake the valuation at the end of each month, every week, every 3 months, every 6 months. So FEDI has told that you should do the valuation of your forex reserves, means your dollars, anything which you have. After every what? Every month, every week, every 3 months, every 6 months. So what has FEDI told? It is every month. Okay? Every month. Correct. Every month. Vijay is an exporter in Gujarat and wishes to use the help of BankX for assistance in handling documents on collection basis for sending to foreign correspondent bank. Which type of foreign exchange facility will be provided by the bank? So, Vijay wants to do some export, isn't it? Exporter. He is an exporter. So, Vijay wants to do some exports to some foreign country. Country's name is given? Not given. Okay, he wants to do some export. So, this bank, his local bank, will help Vijay in what form? Number 1, advising, handling of export documents, collection of export documents, financing, or all of them. So what can the local bank help? Can the bank help in only A, B, C, D, or is it E, all of them? See, it can help in all of them. Kindly note. The bank can perform, see, single bank can perform the function of all. It can perform the function of advising, then confirming, negotiation. It can do anything. It depends on the capacity of that bank. Okay? Next. What is the objective of ISBP 821? Now you get a question on UCP, ISBP, URR you might get. Standby LC, chances are rare. But UCP, ISBP you will get it, definitely. What is the purpose of objective of ISBP? To provide guidance for issuance of LCs, to encourage uniformity of practice worldwide, to reduce the number of credits rejected by the bank, to provide a set of rules for bank-to-bank reimbursement and all A, B and C. What is it, everyone? What is it? Is it all A, B and C? Generally, whenever we see this question and we see the answer, all of them, all A, B and C, generally when we see this, we feel that it's all, but the answer over here is not all now. Okay? The answer over here is only B. It's not, see, guidance for issuance of LC is given by UCP, UCP 600. Okay? And bank-to-bank reimbursement is done by URR 725. These 3 document names you must remember: ISBP 821, UCP 600 and URR 725. URR is for reimbursement only. UCP is for LC issuance and ISBP is for guidance. See, it's very simple. ISBP is a supporting document. Supporting. It supports UCP. Okay, it is a support to UCP. It itself doesn't have its existence. Okay, means in school level, whenever you are in the school, right, you have 2 things. let's say you were in 7th, 8th, 9th, wherever you were, right? So you had two things. One was a textbook. You had this textbook. And second one, you had guide, right? Guide. You had one guide and you had one textbook, right? So this textbook is important or guide is important? Main is who? Main is textbook, right? Main is textbook and guide is a support. So guide is a support to textbook, right? Same thing is over here. This is ISBP and this is UCP. So ISBP is always a support to UCP. It can't have its own existence. ISBP will never have its own existence. Got it? Clear? Next. What is the objective of ISBP? This done, I think so, no? Done. Which type of LC is available for transfer in full or in part in favor of any party other than the beneficiary by the advising bank at the request of the issuing bank? So, which is allowed for transfer. So, what is the answer for this? Which type of LC is available for transfer to any party? It is transferable LC, correct? It is transferable LC. Got it? Transferable. Just now we saw that back to back and transferable, right? Transferable LC. Done. ICAP means, what is ICAP? ICAP means what? Internal Capital Adequacy Assessment Process and remaining all. See, I'll directly give the answer. Answer is this. Okay, ICAP means name first one is right. Okay, ICAP is under the second pillar of Basel III. Second pillar, supervisory review. ICAP has a rating. Every bank has a ICAP. And RBI has a model ICAP, standard ICAP. So RBI will compare its ICAP with the ICAP of the bank. And if there is a deviation, they will reduce the rating. RBI says our ICAP is a standard one. You also should have the same ICAP. What is ICAP? Basically, see this, capital adequacy assessment. Okay, is your capital adequate? They check all the processes in that ICAP document. Okay. So kindly remember, ICAP means this. Prepayment of loans or premature withdrawal deposits denote credit risk, operational risk, embedded option risk, group risk, default risk. So, what does it show? Prepayment or premature withdrawal of deposits denote what? Credit risk, operational risk, embedded option risk. Okay, so now I think so we are on the closure because all of the students are going. They want lunch, dinner time, right? Everyone is focusing on dinner time and have proper dinner. See, pay attention everyone. Have proper dinner, have proper sleep. That is very much important. Proper sleep is very much important for tomorrow's paper. If your brain is not having that much rest, paper becomes tough. Have proper sleep. Don't worry. You have studied a lot, so that's enough now. Okay? Depositor's photo is not obtained while obtaining the account in many cases. What type of risk is it? Market, credit, business, strategy, internal control and exchange rate. So depositor's photograph, if I don't take the photograph of the depositor, it's an operational risk, internal control. See, it's an operational risk basically. It's an operational part. So it's an internal control risk. Got it? It's an internal control risk. A bank holds a security in advance account that is rated as A+. The rating of the security migrates to A. What is the risk that the bank is faced with? So A+ becomes A+, has now become A. So it is downgraded. Downgrade. Okay, downgraded. So what is this risk then? Market risk, operational risk, liquidation risk, credit risk and interest rate risk. So it is downgraded. Downgrade means it is liquidation. Okay. Actually, it is credit risk. Credit risk can also be one part, because liquidation means what? You are not able to liquidate it. So it means the market is not checking, not trusting, okay, this company. So it's a sort of credit risk only. It's moving towards default. But specific answer is market liquidation risk. Nobody is going to buy a bonds. Pakistan. Suppose if I ask you to purchase the bonds of Pakistan, nobody will purchase it, right? Default. Which one is not the part of common equity tier 1 part under Basel 3? So I think so we have done it just now. No, we have not done it. Which one is not the part of CET1, okay, under Basel 3? Equity capital, share capital, dividend, statutory reserves and general reserves. So not a part of this equity CET1. So it is dividend. Dividend is not a part of that, correct? Because dividend is distributed. Dividend is distributed. How can you keep it? Okay. So it's not a part. Which of the following is the best explanation for inflation? Inflation. Increase in income level, decrease in income level, decrease in income level and increase in prices. Increase in money supply and increase in prices. And increase in money supply. So what is the answer for this? Change the exam submission time. Acha? Where many students might be leaving early. Okay, that's why they might have changed the exam submission time. Many students immediately leave. Okay, they leave, sometimes the student leaves in 15 minutes only. So that's why they have changed it. And if that student goes out and leaks the paper, then that's why. So it is, the answer is D, correct. Increase in prices and increase in money supply. Demographic dividend is directly related to, I'll give the answer, stock market, performance of the economy, GDP, population and income from agriculture. So demographic dividend is directly related to, correct, D na, population. Yeah, it is related to population. Okay, it is related to population. Venture capital fund provides financial assistance to high risk ventures only, high technology ventures, highly profitable ventures, high risk and high technology ventures, and first time entrepreneurs. See, generally VC is provided for this only, high risk and high tech. Okay, high risk and high tech they provide. Got it? NISM, National Institute, now these are all miscellaneous questions. NISM, National Institute of Securities Market, has been established for trading in securities, providing professional certification, coordination, granting license and establishing norms. What is the answer in this? B, correct. NISM, we have this AMFI certificate, mutual funds, right? Mutual funds. That is because of this NISM only. Okay? Certification. So B is the answer. Corporate governance measure for Indian companies have been defined by. So who has defined this? RBI, Ministry of Finance, Confederation of Indian Industries, SEBI and Associated Chamber of Commerce. So who has defined this? It is SEBI. SEBI plus Companies Act. Companies Act. Okay, two of them. Two of them have defined this corporate governance. Which of the following is not true about the payment bank? Minimum paid up capital 100 crores. For first 5 years, promoter stake should be 40%. Voting rights of one shareholder need not exceed 10%. Maximum deposit from one customer shall be 1.5 lakhs and it cannot undertake lending business. See, very important, from Payment bank. You might get a question tomorrow on payment or some that other bank is there. Okay. SFB, Small Finance Bank. So the answer for this is D. It is 2 lakhs. 2 lakhs. Remaining all are true. Minimum paid up capital is 100 crores. First 5 years promoters holding is 40%. Voting rights of 1 shares it should not exceed 10%. And it cannot undertake lending activities. So 2 lakhs. Which of the following is not a characteristic of SFB, Small Finance Bank? Again, let me see. At this 100 days equity, 50% of the loans, 25 lakhs. Loans to priority sector. Yeah. What is the answer in this? Yes, correct. Karthik. Very good. It is E. The answer is 75%. 75% of the finance to priority sector. Okay. Which of the following would be wrong approach in financing working capital? Wrong approach. So what is the answer in this? Wrong approach in financing working capital. It is long-term debt. Correct. B. B is the right answer. B. Long-term debt. Okay. Next. A company's NSFR has declined below the regulatory minimum. Which of the following actions is least likely to improve NSFR in the short term? Least likely. Look at this. Least likely means which will not increase the NSFR. Increasing long-term debt issuance, reducing short-term wholesale funding, issuing new equity, and selling of illiquid long-term assets. So which of them will not increase the NSFR? Not likely to improve the NSFR. See, if you increase the long-term debt, it means long-term stable funding is there. Long-term debt means 10 years loan. If I take a 10 years loan, so it means what? I am getting a stable funding. So this is true. Second is what? Reducing short-term wholesale funding. So reducing the short-term funding. Short-term means what? The lender will come to me immediately after 2 months. Give me back my money. So that is reducing. That is also right. I must go for long-term funding. Issuing new equity. Now this is not right. Issuing new equity means what? Okay? Issuing new equity. Okay, this is not right because equity will not affect that much about NSFR. NSFR is basically Basel norms. Okay, it is the 4 ratios which are there: LCR, NSFR, leverage and CRAR, means Cook's ratio. Okay. So C. Which of the following is most effective approach for a multinational corporation to centralize liquidity management across its diverse global operations, considering the foreign exchange and regulatory complexities? So which of them is the most effective approach for a multinational? So what should a multinational do? Suppose let's say Citibank is, or in let's say SBI. SBI is a big bank. So what should it do? It is having the branches all over the world. So what should it do? Establish individual treasury functions in each subsidiary. Every country will have a separate treasury function. Implementing comprehensive pooling structure. Pooling means common. Okay, all the branches in the world will pool the funds to a common structure or common entity. Okay. Investing all excess cash in single highly liquid money market fund, relying solely on local bank financing for each subsidiary. What is the answer? Pool. Pool is the right answer. Pool. Okay, establishing comprehensive pooling structure. Okay, comprehensive pooling structure. Got it? Comprehensive pooling structure. This is the right answer. A bank experienced sudden and significant deposit outflow due to negative market sentiment. This risk is primarily represents the following manifestation of market risk, credit risk, funding, liquidity risk, and operational risk. See, understand the meaning. There is a sudden outflow of funds. So what will it give rise to? Outflow of funds. See, actually, the word over here is due to negative market sentiment. So this means actually reputation risk. Reputation. Okay? Reputation. But the option is not given over here. So you have to choose between the options. So in the options it is funding liquidity. Right? You are facing the problem with funding liquidity risk. You won't have money, right, to pay. Consider a scenario where a company has very high current ratio but low quick ratio. This suggests that a company likely possesses excellent short-term liquidity, significant reliance on inventory for meeting short-term obligations, excessive cash reserves, a strong ability to convert all its current assets into cash. So, a company is having huge current assets, okay, but low quick ratio. So liquid assets are less. So what does it mean? It means that companies rely too much on inventory. Okay, what are current assets? See, current assets means current assets equals to, see this, cash plus debtor, okay, debtor plus inventory plus liquid asset, prepaid expenses, prepaid. So these two are known as liquid assets. Liquid assets. So current asset means liquid asset plus these two. Okay, current asset means liquid asset plus inventory plus prepaid expenses. Okay, so if you are having huge current assets and low liquid assets, it means you have this much, this is huge. Okay, that's why this is generally not there in bank, in any company. Companies don't prepay anything. So this is huge. Inventory is huge. Okay. Global Ventures Incorporation has a current ratio of 2.5, which is higher than the industry average of 1.8. So the company has huge investment in current assets, which is dangerous. Company is in good position and continue to increase the current assets. Both A and B, neither A or B. This is the last question for today. Okay. This is the last question for today. So it is answer is, you can say both A and B also, but the answer is A actually. A, dangerous. Okay, which is very dangerous. Okay, it is very dangerous. Okay. So kindly understand this. Okay, everyone. Clear? So everyone now, before going, kindly note the new, say this. All of you, before going, kindly note you can join the new batch, okay? The new batch, or you can join the increment Mahapack. See the new batches of revision power pack batch. Now still 3 subjects are remaining. You can join this power pack batch for the remaining 2 subjects also. Specific subject wise also you can join. Okay. So you can join this, plus those who are planning to appear for November, this coming November, you can join the Mahapacks. Okay. Join the Mahapacks immediately, because these Mahapacks, say this. See this, CAIIB Mahapacks, if you join, right now you are getting 2x plus 1 month validity. Okay, 2x plus 1 month. Here you are getting 15 plus batches per subject. Per subject 15 plus. Okay, it's a huge thing. Plus you are getting 82% discount. Use the code Y432. Never forget the code Y432. Say this. Use the code Y432. Y432. Okay. See this. 81% discount plus 1% extra. Those who are planning for November, join it ASAP. Okay. Till bye and best of luck. See, at night I am having 2 more sessions. Night I am having Chalisa. Tomorrow morning I am having this expected paper. So follow both of them. Okay. Chalo, bye everyone. Best of luck. Hope so you have enjoyed it. Okay.